Hi, good morning, everyone. Thanks for joining us for our morning call. So for today, for our stock counter updates, we have Sembcorp, Comfort DelGro, and HRnetGroup. And for Phillip on the ground, we have Singapore Press Holdings, Japfa, and Sunpower. And we'll end off, as usual, with our Singapore Weekly. So without further ado, I'll hand it over to Terence.
Hey, thanks, Glenn. So for our report on Sembcorp Industries, we covered their second half 21 results. Revenue was up 59% year-on-year, while profit before exceptional items was up 46% year-on-year. This was driven by the conventional energy segment. Sembcorp Industries also declared a final dividend of 3 cents per share, bringing full year dividend to 5 cents. In terms of some of the positives, full year 21 net profit of $300 million was above our estimates, forming 146% of full year 21, our full year 21 estimates. This beat came from conventional energy through higher dark and spark spread, especially in the fourth quarter of 2021. 85% of sales thermal plant capacity now comprises mid and long-term PPAs, long-term power purchase agreements. We penciled in a reversal of CO2 losses from 2023 onwards. So just to recap, CO2 has traditionally, since their operations in 2017, they have traditionally reported losses in CO2, mainly because of the result of the absence of any mid and long-term PPAs. So with the penning of new mid and long-term PPAs, we now expect CO2 to reverse the losses for Sembcorp going forward. Net gearing also declined by more than 20% of our forecast for financial year 21, as free cash flow rose by more than 71% year-on-year. So if you look at the table here on your left-hand side, if you look at the net gearing, which is the last row here, for second half 2020, the net gearing was 2 times. Was the latest financial year actually came down to 1.6 times, which is about 20% lower than our forecast, mainly due to the faster repayment of project finance debt for their India business and Sembcorp Green Infrastructure. In our next slide, in terms of the negatives from their second half 21 results, we expect revenue to be slightly impacted from the major maintenance shutdowns expected in 2022 from the shutdown of their Vietnam plant, which will be expected to impact revenue. The expiry of the PPA in 2024 is also expected to have a drag on revenue. For full year 21, land sales also came below our forecast. Full year 21 total land sales came in at 168 hectares versus the 180 hectares forecast that we had. To recap, Sembcorp Industries had initially set a 500 hectares sustainable land sales target that they wish to achieve by 2025. So financial year 21 came in a bit lower, and that's because of slower land sales in China. In terms of the outlook, Sembcorp Industries is continuing the transition towards a green energy future. No equity financing is required for their transition towards greener energy. But conventional energy is expected to still perform well in 2022. How we want to just say, for conventional energy, in terms of how it will perform, it will still be dependent on the energy prices and demand going forward. But for the first month, based on Sembcorp's observation, the company's observation is, for the first month of 2022, conventional energy continued to perform well, mainly because of better spreads in their key markets. Sembcorp is also on track to achieve 10 gigawatts of installed capacity by 2025. Just to track their performance for first half 2022, they are expected to hit 6.1 gigawatts of installed capacity. So that's about 3.9 gigawatts away from their total installed capacity by 2025. In our last slide on Sembcorp, in terms of our recommendation, we upgrade Sembcorp from neutral to accumulate. Our financial year 22 PATMI is raised by 6.8%. Our target price is also raised to $2.94 as we roll forward our valuation to 1.2 times FY22 price to book value, the average of its peers. So what we did, if you look at the table here on your left-hand side, so it's a little bit small, but if you look here, we look at the comparables of the Chinese companies and the Indian companies, and then we look at the average of the price to book value. Of course, what we did was to remove some of the outliers like Adani Green Energy and Indo Wind Energy. to arrive at the average of its peers, and then the average that we have for their comparables is about 1.2 times. So we peg this to Sembcorp Industries to arrive at our target price of 294. That's all for me for Sembcorp. Our next company is Singapore Press Holdings, SPH. This is a Phillip on the ground. We hosted SPH in our Phillip on the ground last week, and these are some of the notes from our meeting. SPH management informed that they have obtained court approval granting leave to convene the Cascaden scheme meeting. The court has also granted leave for it to withdraw the application to convene the capital scheme meeting. SPH will also defend its position on arbitration with Keppel. Management will not speculate on the outcome and timeline of the arbitration with Keppel, but they did say that the process could take anywhere between a few months to years. There were some questions also on the recent sale of their SG Kama business to the Toyota Consortium, which saw them realize about $100 million gain. There were some questions on whether the Cascaden will increase the offer price to shareholders in light of this sale. For what management says, they cannot speculate on what Cascaden will do, but they do not expect any further revisions to the offer price. SPH management continues to recommend shareholders to vote for the Cascaden deal. In our last slide on the indicative timeline for SPH, the dispatch of the composite documents, notices, proxy, and request forms have been sent out to shareholders on the 20th of February last month. The response, the deadline for SPH shareholders to respond is the 19th of March. The scheme meeting and EGM will be held on the 22nd of March. If SPH obtains shareholders' approval, they will go to the court for sanction to sanction the deal in April of this year, and they expect that from mid to end April, there'll be the election process for shareholders to choose the form of the Cascaden scheme consideration. So we put here form of Cascaden scheme consideration because, just to recall, Cascaden has two offers. There's two forms for the Cascaden scheme. First, the first option on the table for SPH shareholders is an all-cash offer of $2.36 per share. The second offer on the table is a combination of cash and SPH REITs. They expect the scheme effective date to be end April and to early May 2022 rather. Shortly thereafter, in May, they expect the completion and the payment of the Cascaden scheme consideration, depending on shareholders' election and delisting of SPH. The management do not expect any complication to the deal from the Keppel arbitration at this point in time. So that's all from me for SPH. I'll now hand over time to Vivian.
Thanks, Terence, and good morning, everyone. So I'll be doing a Phillip on the ground for Japfa. This is their FY21 results, and just a note, we do not have coverage on Japfa. So Japfa has three main segments. Firstly, you have the PT Japfa TBK, which is mainly present in Indonesia. So they sell the feed and they do fattening and all that. This contributes about 68% of FY21 revenue. Animal protein other is mainly in Vietnam, also in Myanmar and India, which is about 20% of the revenue. And lastly would be the dairy segment, which is present in China. This makes up around the remaining 12% of the revenue. So for the 4Q21, you refer to the chart on the top right, we saw higher revenue mainly due to the increase from PT Japfa, but continued lower PATMI as a whole. So on a FY21 basis, revenue was up 20% to $4.6 billion US, and PATMI actually declined 35% in view of the lower margins to about $119 million. So zooming into the individual segments, firstly for PT Japfa, we saw sales volumes increased, and with feed margins tightening even further, the segments still remained profitable, and feed also remains to be Japfa's pillar of profitability. And secondly, it would be broiler prices recovering in 4Q21, as you can see from the chart on the bottom right. This is mainly due to the lockdown measures easing and recovering demand for chickens. Secondly, on APO, animal protein other, So this segment saw consumer demand in Vietnam continue to be dampened by the strict lockdown measures, and management shared that even till now, schools are still on half day. So this segment was similarly impacted by higher feed raw material and global shipping costs. And in the second half of 2021, late last year, the resurgence of the African swine fever, ASF, affected the operations and also the profitability in Vietnam. Lastly, for this segment, on the Myanmar side, they have continued reducing the scale of the operations. So revenue contribution for FY21 from Myanmar was 1.7%, down from 2.5% in FY20. Lastly, for the dairy segment, full year revenue increased with additional contribution from Farm Aid and also the 2 newly acquired farms in Shandong. And in China, the raw milk ASP remains strong due to the persisting supply shortage. On the outlook, Japfa will be maintaining their large-scale operations, and it's also through this and the vertical integration that they have managed to remain profitable. So of course, I'm not forgetting using the technology to raise productivity even further, and also other measures to keep the costs low. So that's all for Japfa. Next, I'll be moving on to Sunpower's FY21 results. Again, we do not have coverage on Sunpower. Next slide, please. Thank you. So Sunpower is the exclusive supplier of industrial steam, so including steam to industrial parks in certain areas in China. So steam sales volume is a main metric for them. And for 4Q21, we can see from the chart on top right that steam sales remain about the same, stable, but revenue increased more than 3 times, as we could infer from here that they adjusted the prices quite a bit upwards. But even with that, you can see that gross margins still collapsed from 28% to about 1.5%. And similarly for PetMe, which fell almost 93%. On a full year basis, steam sales volume increased 45% to almost 8 million tons. And for GI, the green investments, which is their main segment of business, after the disposal of manufacturing and services, the recurring revenue reached 2 billion RMB, up 50% year on year. But the PetMe was also down 31% to 135 million RMB. So we can see that, as mentioned, the margins were impacted by the surge in the feedstock prices. So a bit of an illustration, if you refer to the chart on the bottom right, this is the changes of how coal prices have varied since late 2020 to recently. So you can see that in the second half of 2021, coal prices were steadily going upwards, but in nearing the end, or maybe around October period, it surged almost 5 times to almost 2.5k RMB per ton. This is up from 500 in 2020. And even recently, it's still reaching the 1,000 level. So it's still quite elevated. And to deal with this, Sunpower has tried to raise the steam prices. So management shared that in 2021 alone, they have adjusted the steam prices about 36 times. But the mechanism works such that they are only able to pass on 100% of the higher costs when the changes in coal prices become a bit more stable, maybe similar to the kind of variation that you see in late 2020. Yeah, so they have also, other than that, they have also managed to achieve some cost savings through using the blended combustion of sludge and other wastes. Some updates for Sunpower include Shantou Project Phase 1 now in full operation with new revenue streams added, and that includes the compressed air and waste products. Other than that, the Shanxi Xinjiang project is expected to commence operations in the early part of this year, while for the Xingyuan plant at the Jimo International Trade Park, they have also expanded coverage area to supply the clean heating to more customers. So in 2021, the total length of the green investment GI pipelines reached 372 kilometers. This is up 23% year on year, while the number of customers are now at 525. So quite good growth momentum here. And moving forward, the steam demand in 2022 continues to look strong, and Sunpower has additional capacity coming online to capitalize on this. So that's all for Sunpower. Next, I'll be passing the time on to Paul for Comfort DelGro.
Thanks, Vivian. So on Comfort DelGro's fourth quarter 21 results, the results was below, the headline numbers was below our forecast. But once you exclude some of the one-offs such as their disposal loss on buses impairment, there was around 10% below our estimates. The positives that we saw from the results was basically the operating leverage is intact. I mean, despite revenue only rising 3%, you can see from the chart on the left, the profit was up almost from 3.3 million to 32 million. So you can see the huge operating leverage. Curiously, one of the contributing factors was also lower depreciation as they've been lowering their capex over the last 2 years. The negative is the sluggish taxi revenue. So you can see on the table on the left again, revenue was down 11. It was due to the rental rebates that they gave of almost 25% in fourth quarter. The rental rebates continue into first quarter 21. But some of it will be, because of the higher taxi fares, that should kind of improve the driver takings. Last year in FY21, they subsidized almost 90 million in taxi rental rebates. That means instead of collecting 90 million of rental from taxi drivers, they just give it as a discount. In terms of the outlook, I think the challenge for this year will be fuel price and electricity costs. But in general, so for the bus operations, there are largely three parts to the business. So for bus operations, they will be able to pass on the higher fuel costs because there's a fuel indexation. So most of these bus contracts are, you're just giving a fee to just, to just drive around. I mean, basically that's as simple as that. For the second part of the business, which is taxi, the drivers will bear the brunt, although most of the fleet now, 60-70% is already hybrid, but they will still bear some of the higher fuel costs. But with improving economic activity and also higher fares, that should soften the impact. The one that will probably leave them more exposed is the rail business from higher electricity costs. Because the ability to pass on higher costs, is next to almost impossible because every year you get the fare review, but in the end, only a small amount is passed on. So most important for them will be the passenger traffic recovery. So that's the most critical. We still maintain a buy and an unchanged target price. In the past 2 years, the company has generated about 900 million in free cash flow. So although the results was very poor and so forth, they still managed to generate almost 900 million cash. And our PATNI, we actually lowered by 10% because we're taking into account maybe a bit of higher electricity and staff costs. We still find the company's valuations attractive. It's still our reopening and recovery exposure. And they are backed by, we think in FY22, they should be able to revert to almost a 5% dividend yield. They got strong cash in the balance sheet, and the share price since the pandemic is down almost 40%. Next slide. Next one is HRnet. So we think it will be another record year in 22. So in terms of the results, they beat our forecast by 8%. But it would have been higher because they actually had some 2 million of fair value losses. So the earnings would have jumped 37% instead of the 14% headline number that you saw, that we see on the table on the left. In terms of the positives was that both the divisions did well, the permanent, recruitment, and flexible. So permanent is the usual executive level kind of hires. Flexible is those temp workers that, for instance, the healthcare sector or even those in the retail, they need or promoters or whatsoever. So these are flexible staffing. And you see the big number, the 200 million, that's because HRnet will actually pay the salaries of these staff on their balance, on their income statement. That's why you see such a huge revenue number. So all did well. I think the ones that did best was healthcare, manufacturing. Manufacturing was mainly North Asia, India, and also IT and tech. So those jobs are Singapore and also in North Asia, China, and also Taiwan. The other positive was the dividend. So the dividends jumped 60%, including a 1 cent special. And they should be able to maintain such dividends. The 4 cents is equivalent to roughly, I think, 40 million. And their cash from operations is more than 50 million, and Also, they got like 300 million of cash. So the capex is only a modest 1.3 million. The negative for us was the volatility that we see from their 30 million of listed equities and debt. So most of these are HR-related services companies that they buy and put in the portfolio. But the issue of this is that it will create unnecessary volatility. It will just make the earnings swing up and down a little bit. At the margin of maybe 10-15%, like we saw for this year's results. So in terms of the outlook, we expect another record year in 2022. For the volume will recover will be strong for the permanent hires as economic conditions improve. And you know, the vacancy rates as per in our report is at record highs in terms of vacancy rate, including managerial level, the PMETs and so forth. And the other phenomena that's happening apart from the improving economic conditions, that clients are working more with the recruiters because the tight labor market and inability to hire foreign workers or overseas employees. So they will want to work. Usually if supply is abundant, the employers will just go on their own and recruit. But because it's so tight, they need more and more support and help from the recruiters. And the second thing is that when salaries are rising, and most of these recruiters are paid maybe 2.5 months of salary of the employee that they kind of placed out. So that will also help in the margins. On the flexible staffing, that we think remains healthy as the other sectors will start to reopen, such as consumer. So we still maintain a buy. We raise our target price because we raise our earnings. We nudge lower our valuation metric because the growth will be strong, but probably won't hit the kind of 40% that you saw this year. So we still like it. They pay like a 5% dividend yield, net cash 300, and also they have the unlevered ROE of 16%. But if you assume they actually pay back, you assume X cash, this company is trading more than 100% ROE because they virtually have very minimal capex and it's very asset-like. Next slide. In terms of our weekly, we had some retail numbers coming up from Singapore for January, but because Chinese New Year this year is 2 weeks earlier, so all the headline numbers look really good. So the best way is you only can get a trend if you kind of combine January, February. So by February numbers, we should be able to see the growth. So I guess the interesting thing is that supermarket did very well, but we just need to see how the February numbers fare. In the US, they announced very good numbers, although nobody paid attention because everyone's looking at Ukraine and oil price. But the employment was very strong, the highest in 7 months, and the unemployment rate is almost back to full employment to the pre-pandemic lows. So-called deflation shock, at least at a very strong, at least. Oh, sorry, the internet is a bit uncertain. We also had some commentary from Powell. So you can see that he will raise rates by 25 basis. Then they're willing to go more aggressive. But conditions are so, economic conditions deteriorating is another topic. We have some good PMI numbers. The next one, tactical views. So the market now is worried about a stagflation. Europe is facing this crunch in energy, so the bank exposure to Russia, but that maybe might be a bit more contained because some study the impact maybe 20 to 40 basis points on the capital. So it's not as damaging as, you know, like when you had in 2013, the whole Euro crisis. The higher inflation is going to hurt most of the consumer names. So for us, I guess what is happening now, so right now, what is happening now is that because of the US stance, so the unknown now is how only like Russian oil. So if this happens, then this how long can the US take this, especially when you got that's the big unknown and that's the overhang for the market. We think the market is really pricing quite a lot of risk. If they buy Russian oil, then the Republicans would just say, oh, you're buying, you're funding. Then the skyrocket, inflation going to surge. You're also going to lose the midterm elections. So they are in this very, very tight balance. My own views. And of course, for us, the NATO is not coming into this war conflict because they consider themselves a defensive alliance. Oh, okay. So sorry. So sorry. So let me just repeat. The main issue in the market now is how high oil price will be. And that is stroked because of US saying that they might want to ban Russian oil. So one scenario is they will do it. So assuming they do it, oil price will spike, but he knows he's going to lose the midterm elections if they do it. So he might do it just for a while and then he will stop. That's one scenario. The second scenario is that the US will just keep on talking. They want to ban, don't ban. And hopefully they can just get through it and just avoid doing it because they know it's disaster. But if they still buy Russian oil, they're gonna get infected by probably the worst evil because you will just be like you're funding the Russian conflict, but at the same time you're not stroking like higher gasoline prices. So that is the risk. That's in general. That's the nutshell. That's the whole issue plaguing the market right now. Yeah. So sorry, the internet is patchy. Apologies for that. So I hope everyone kind of understood that part. So for that conclusion, it's very hard for us to tell you because it's all based on how the US will react. But for us, if the US do say they want to ban, even if they do that, it would not be on a sustained basis because you take 40% is Russian oil, so there's almost no way you can contain because there's virtually won't have any gasoline in the US. So if they do that, it will only be for a temporary period. I mean, that's one scenario, but I mean, we can only tell you the scenarios. The other number that on the weeks ahead, the key one will be the US CPI, but I think nobody really will pay attention to it. But anyway, we also have a HRH webinar this week. Next slide. Yeah, sorry for the patchiness. This is just for reference. Next slide. Okay, for this one, the interesting thing is that for what it's worth, Singapore is at least building herd immunity. If you're getting like 20,000 a day, you can do some numbers. You probably can get like a couple of months, the population is going to get herd immunity. So even if 20, which is understated, if you assume 30, 40,000, then you're more or less going to get this herd immunity. Next slide. Okay, let me just run through some of the highlights of the UMS analyst briefing. So for UMS, for those who don't know, they are into front-end equipment. So their main customer is Applied Materials. You see on the bottom right, AMAT. So on the fourth quarter numbers was actually, although you see the headline was very strong, 351, but it was actually very weak because of the taxes. So if you look at the table on the right, the fourth quarter only contributed 5 million compared to the whole year 53. That's because one of their subsidiaries or manufacturing in Malaysia could not get pioneer status. So pioneer status basically means you are tax-free because they couldn't meet the local hire. So this was probably the one that disappointed the market, but they said that they'll need a few months to resolve this. The other thing that was mentioned is JEP, which is their associate, also listed. That did well because because the demand so strong, so UMS outsourced some of their components to JEP, semiconductor components, to JEP because JEP got a lot of extra capacity in Singapore and in Penang. So the other main important thing is that they are on the works to build their new factory in Penang to be completed end of this year for 1 or 2 customers. They didn't mention names, but the size is huge. It's almost 300 square feet compared to the 500 in Penang. The other thing they highlighted was the aluminium cost is skyrocketing and they may not be able to pass through everything. Again, this is just an update. Labor in Malaysia is a challenge. So in terms of the outlook, the forecast is still strong by the customer, and there are new customers under discussion for Penang. So our guess, and it's probably all the analysts also just guessing because they don't give any metrics, right? So we think UMS in this year could probably grow maybe 20-25%. If you look at Applied Materials, which is their main customer, they are guiding for their February to April, they're looking at 16% year-on-year growth, and UMS usually tends to grow faster. So you could think that the whole year they're looking at maybe 20-25%. So for this year, probably UMS can grow 20%. Then for 2023, the other growth driver will be them getting the new customer, which will only kick in second half 23. So for the next 2 years, there is some growth visibility for UMS. Although 23 might be a bit slower, the growth rate, depending on how fast they can ramp for the new factory. Yeah. So again, this is just some of our thoughts after having the briefing. Next slide. Okay, the next one is just Food Empire. So Food Empire, again, was just out of interest because Food Empire sells instant coffee mainly into Russia and Ukraine. Okay, so this is the results even before the conflict. So even before the conflict, the earnings was down 40%. And that's because the margins just collapsed. And the margin collapsed because they said everything is rising. Freight cost, sugar cost, coffee cost, dairy cost, everything is rising. So even if they do raise prices, it will take some time to raise. So you have to take in all these costs before you can actually raise price. So in terms of the conflict, they couldn't really share that much. I mean, because they said that it's only 5 days old, they need to assess. Their factory in Ukraine is still intact. One of the logistics issues is that they cannot ship to Russia because the ports are closed. They have to ship to European ports. And I think as we speak, they're also trying to figure out how to settle this issue because they've got SWIFT issues and all that. So they couldn't share much, but they just said that they have inventory, but maybe 1 or 2 months. And the ruble, they've got some ruble exposure left, just a little bit. They managed to repatriate some of the money. And again, they are unclear, the banking system, and it's hard to operate when you do not know what is the level of ruble. So basically, there's really no clarity and everything's evolving. They just said that they faced such ruble volatility in the past before, in 98, 2014, just as bad, if not worse. But they have enough stocks. But the issue now, this company has probably net cash of 10 million. And then, as you can see from the table, almost 60% of their profit is from Ukraine and Russia. So it's going to be without stating obvious, it's going to be an extremely challenging. I mean, this segment could actually turn to losses from profit right now. So again, this is just an update for anyone who was interested to know. Next slide. Okay. Again, because today, so just to give an update on the commodities, you can see the pressure consumer companies will face on the agriculture side. Not so much year to date, but if you just look at the 12 months, you can see that coffee is up 75, corn is up 39, palm oil is 72. Even tin, like someone like Del Monte, where they sell canned food, they will also face like a doubling of their tin costs. But Del Monte, as you mentioned before, has been raising prices at least 2 to 3 times since this thing happened. Then aluminium is another factor which affected UMS. The stock exposure is all for you to see, those XGX. It's just for your reference. The table on the right is just to note inventory levels and oil price fundamentally do move quite in tandem, as you can see from the red line, which is oil price, and the blue line, which is inventory. So the last time inventory was this low, it was when the oil price is $90, but of course now it's trading 120, 130 because of the whole Ukraine conflict. But again, this is just for everyone's reference. Next slide. Okay, we do through our usual model portfolio update. So we were up about 1%. Half of our portfolio just moved sideways. What pulled us down was DBS and QN. What helped our performance was Comfort, Keppel, and Del Monte. This is just for reference. Next slide. In terms of what did well in February alone, the commodities, especially the palm oil names, all did very well. You can see from the sector, what dragged down the market was the banking sector or finance. So the main gainers, the top 10 gainers you see in the middle, all the palm oil names did well. Pumitama, Golden Agri, Geo, and also the coal names, First Resources, Indo. All these are palm oil stocks. The losers, you can see Food Empire, obviously. Then, curiously, even all the medical names were hit badly, and also AEM was also hit badly. And the banks, the STI gainers at the bottom was maybe Sembcorp and some of the property names. The one that did badly was against the banks. Yeah. Again, this is just for everyone's reference. What did well and didn't do well in February. Next slide. This is my last slide. Again, just to get an update on all the performance of all the asset classes. STI, I guess up to February is still holding reasonably well. We're up 3. The worst ones are Asia ex Japan because of the tech stocks. The REITs are also down. Bonds are also down. These are investment grade bonds. US is the worst market, down 8, and commodities are the best. These are ETFs, not just the price of them. Okay, this is just the usual update we do for monthly. I think that will be the last one. You can go to Q&A if there's any.
Okay, maybe I'll take the first a few questions. So someone asked, what level is a good buy for banks? I would say that I can't exactly say what level is a good buy, but for the banks, we do think that the rates, rate hikes are definitely an upside. So that is one thing that we can look forward to, as well as now most of the banks are expecting lower credit costs due to mostly lower SPs and also possibly more GP write-backs. So those are the two main things we can look forward to for the banks. And lastly, I would like to point out, I think this links to another question, that the banks are not as exposed to Russia and the Ukraine conflict. So anyway, I'll move on to the next question about banks. He asked, if this war drags on for another 2 months, do you see the banks going down more than 10%? It's a very specific number, 10%, but I don't really think I can confirm or deny this. But what I can say is, as I said earlier, that the two banks, so all 3 banks have said,
Sorry, I think Glenn's computer just crashed.
Can we just take on the other questions?
Hey, sorry. Am I back on?
Yes.
Okay, so I'm just using my phone. Sorry, my computer crashed. So I'm just using my phone now for now. So I will continue on with the Russian exposure. So both DBS and OCBC have said that they have very minimal exposure to Russia. And UOB has come up to say that they have actually no direct exposure to Russia. So I don't think the local banks are very exposed to Russia. So that's all I can mention about that question. So that's all for me. I'll just hand on over to my colleagues.
Yeah, I'll take over from Glenn. There's one question here from Michael. Terence, please comment on the factors behind SCI's excellent share price performance. Anything to do with ESG fund inflow? So there's no data that we have to say that the SCI's good share price performance is related to ESG, but we think there's a possibility also because SCI's move from brown to green to really turn their portfolio from focusing on fossil fuels to green energy could have seen ESG fund inflow, but we cannot say definitively. The second question is, does green energy investment of SCI really have better ROI than its existing fossil fuel plants? So yes, And so to put things in perspective, when you look at the profit before tax margin for their green energy investment, PBT for these green energy investments about 23% for the latest financial year. And this compares to about 3.5% to 4% for fossil fuel plants. So you can see the green energy investments have better margins than the fossil fuel plants. That means that the ROI is also faster. And for the green energy investments, it is still 23% now, but what we have done is we penciled in expansion in margins going forward, because some of these green energy investments, the SCI do have a very heavy finance cost upfront loaded into the margin, which is a drag for the interest cost. But as they start to amortize this interest cost over time, then you start to see the interest cost go down and the margins start to increase over time. So that's a pretty long answer, but the short answer is yes. I think that's all the questions for me so far. I'll hand over the time to the rest of my colleagues.
Okay, let me just try some. Can comment on the venture manufacturing and Jardine second carries prospects. Yeah, I think for venture, at least, I think we are still positive. What has impacted them? Number one is, of course, the whole supply chain constraint. And number two, they are operating out of Malaysia. So Malaysia is still enjoying flows from China in terms of electronic company moving into Malaysia. And number three is that their life science it will take time for the life science to recover. So we are still positive on venture, and you're still being paid a 4% dividend, maybe higher now, but you're still paid 4% dividend yield as you try to weigh out this whole situation right now where sentiment is so poor. So we are fine with venture. Jardine cycle carriage we don't cover, but you are essentially buying Astra International of Indonesia, which might have done well because of their exposure to coal and coal mining. So the one is harder for us to say because we don't really have an updated view on Astra International. But for me, I would rather just buy Astra International. I mean, since most of their earnings actually come from there, if you're positive on Jardine, yeah. Just that, sorry, we don't really cover Indonesia, so I can't really give a really firm view on that. Is there any negative news impacting APPT, Asian Pay TV? No, not necessarily, just that our report's been delayed, but there's nothing negative. The results all came everything in line. There was no surprises from us. What's your short-term view and long-term view? I think for semiconductor, what's your short-term and long-term view on SG semiconductor industry? The unique thing for UMS and AEM is that they are very front-end loaded, which is a positive for at least for next 1 to 2 years, because with all this disruption, there's a strategic push to build more foundries, which we all read from the headlines, especially from China and even the US. So all these things, not only just for semiconductor, even energy and the whole shebang with all the supply chain, is that there could be a big capital expenditure wave coming on. We still have to check the numbers, but every country will now be worrying, we cannot keep on having this type of disruption, and freight costs continue to be so high. So you could see investment wave, which we're already seeing in semiconductor. So we think for the next 2 to 3 years, it should still be positive, but we think 2023, there could be a lull because it's really grown so much, right? So the growth rate will definitely slow down for this year and next year, but it will still be growing, but not at the same pace that we saw in 2023. So the outlook is still positive because we are more front-end loaded, the front-end equipment, which is in the building of wafer fabs, which has now become more of a strategic necessity for US and even China. Yeah. I hope that helps. Any views on Hang Seng Index? Sorry, we don't really cover that, so can't help you on that. Is there any factor to explain the weakness of AEM prices this morning in your view? Nothing much. It's just purely sentiment. I don't think there's any. They already gave guidance, and normally their guidance tend to be quite accurate because their guidance is based on customer orders. So Ukraine is going to stop Intel from building any new foundry plants. But of course, no sentiment is just bad. Everything just being sold down. Is AM going down? Is it goodbye? Yeah. AM is not only just on Intel. They also found a new customer in memory, which is ramping up. So I think the outlook is still fine. But like we said, Ukraine war, how it affects the memory guy, maybe demand might be a little bit off from Europe, but I'm not sure if they're going to affect their plants. Yeah. And all these costs is not going to really, UMS a little bit, but all these costs is not going to impact them because most of their cost isn't coming from materials. It's like more like labor and so forth. Please comment on fan stock. Timothy, can you help?
Yeah, sorry. Let me just prepare for this question. You all can go ahead first.
What's your view on CPO stocks as resources? Okay, for CPO, our worry right now is if you buy the commodities, which is good. I mean, the momentum is there. Just that if any positive thing, I'm not sure there's going to be any on the war ending soon or whatsoever, which is unlikely. But that could also hit crude oil because they are, one of the reasons it's running is because rapeseed and so forth also comes from Ukraine. So that's the alternative. And also biodiesel, I think regardless, they're just going to buy more biodiesel regardless whether it's green or not green, because if there's such a huge shortage. But I think that if you look at Golden Agri, the last high was, I think, 40 cents when the last time. So I think we're still far from it. If I had to trade, probably that will be the one which is Golden Agri, because if you compare to, I'm not sure what's the price now. The last time I checked, the last time it traded at the high was almost 40 cents when palm oil price. But if I had to, then probably that's the one. Yeah, I guess. But again, just have to be very nimble because this is purely a bit binary. The US moves ahead and doesn't stop Russian oil, then this thing will all collapse back again. So that's why it's a bit. Sorry, the high was 60 cents. Apologies. Yeah, thanks for that, Mr. Casey. I didn't realize that. I thought it was 40. Maybe I didn't go far enough. Yeah, thanks. Yeah, so the last high was about 60 cents. Probably that would be the one. Again, this is just our own views. I mean, there's really not much like analysis or done to do it out, but it's just my own thoughts. Is calf a buy? I'm not really sure. Yeah. Calf is more, yeah, I'm sorry, I can't help it. It's like on bread. I think they're selling gardenia bread, if I'm not mistaken. I think consumer names have to be very careful unless they can show proof that they can raise prices like Del Monte. Next one is on industrial REITs. So Natalie.
I think I will go ahead first with the FANG question. So for FANGs, with regards to the Ukrainian war, for my coverage under Apple, they did say that they are stopping sales into Russia, but it's a very small percentage of their sales anyway. For Microsoft wise, for them it could be a benefit with regards to cybersecurity, because right now there's an ongoing cybersecurity war that's happening in Ukraine. I think I read some news that Russia themselves got hacked because they didn't upgrade their Microsoft Office to the latest licenses and those forth. So it's because of this cybersecurity war, it's really becoming much more a priority for a lot of people to invest into cybersecurity. So that's one of the tailwinds that Microsoft will benefit, because they are cybersecurity is a big push for Microsoft, for their customers to upgrade their licenses from Microsoft. And lastly, for Amazon wise, they don't really have much of a presence also in Russia. So for them, it's mostly domestic, so in the US. So what we're looking at for Amazon is the wages to stabilize, and also their employment because there's a tightness in the labor market at the moment, which is starting to ease also. So that's a good catalyst for Amazon. So for the FANGs wise, not much impact with regards to the Ukrainian war directly, but of course indirectly is the interest rate headwinds. Yeah, not sure with regards to the other ones like Netflix, Google, and also Alphabet. Jonathan, you want to take those?
Hi, Tim. Yeah, I can take those. So I guess for Facebook, they got banned in Russia. The government put a ban on Facebook and Twitter just to control like the narrative surrounding the war in Ukraine and Russia. But in terms of overall valuation for some of these stocks, especially for Facebook and Google, I think they're back down to March 2020 level. So right in the midst of the pandemic. So you could think about it as having some value to pick it up if you were looking into that. But yeah, otherwise, not really that much news going on for Google and Netflix in terms of especially when it relates to the war in Ukraine. Everything has just been going down along with the overall broader market decline. Yep. Thank you.
Natalie, you got anything on the industrial REITs?
Hi, good morning, everyone. There's a question for me on industrial REITs, Ascendas, Mapletree Industrial. Okay, so for these two counters mentioned, we still like Ascendas REIT. The industrials, overall the industrials, especially the industrials that have exposure in Singapore, we actually saw positive rental reversions across most of the asset classes in Singapore, and also an uptick in occupancy. And overall, for in particular for Ascendas, I think we like Ascendas because of their diversified portfolio. So in Singapore, they also have a significant exposure to business parks, which is expected to benefit from the secular industries such as your biomedical, life sciences, your tech companies. They are setting up or expanding. So the Ascendas does have a significant portion of inventory actually in business parks. Not to mention for Ascendas, because their portfolio, they actually do have opportunities for them to actually unlock these properties by doing redevelopments. So that can be a potential uplift for the portfolio. Ascendas is trading at a relatively reasonable price to NAV, 1.2 times. And that compares to Mapletree Industrial, 1.4 times. I think Mapletree Industrial, because of their high proportion of data centers, that's the reason why it's trading at a higher price to NAV. But in our view, that is also a bit pricey, given that I think some of the data centers within the Mapletree portfolio, they're actually experiencing a little bit of softer leasing, for the data centers in Mapletree's portfolio, the US ones. So in conclusion, yes, we still like industrials, and we're still positive on Ascendas. We do not have coverage on Mapletree Industrial. Thank you.
Okay, let me just take some your thoughts on short-term prospects for Wilmar. That's why you notice Wilmar share price hasn't moved along with the other pure plantations because their consumer business will be affected badly because they're selling cooking oil, and the ability to pass on the price will be affected. Just to refresh, Wilmar, very broadly speaking, has three parts. They got the plantations, they got soybean crushing, or soybean oil, and also they have cooking oil, which is for the consumer. So that part of the business is going to be affected. That's why I think investors or traders will just buy straight the pure plantations because they are the direct beneficiary. Yeah. So Wilmar is more the integrated. So they're, I guess, more stable and more like the profitability won't be so volatile, but it'll be more stable. But their plantations will gain, but the consumer will lose. So that's why the upside won't be as high as the plantations. So I mean, anyone you want to trade on this will be just like the golden agris, which have the higher volumes, rather than buying Wilma because of this scenario. Hi Paul, so the iron ore price slumping 33% in your slide as opposed to all commodities shown. Is that a typo? No, actually, last year iron ore spiked up from March not too late, but anyway. Glenn, you want to take on some on the OCBC? Yeah.
Yep, sure, Paul. So for OCBC, why is there's a question, why is OCBC taking such a beating? I don't think it's just OCBC, but anyway, OCBC, what were the sort of the negatives for their most recent results were that because they had increased SPs, which is specific provisions, of about 109%. So most of this was, they mentioned it was due to project financing delays due to supply chain disruptions brought about COVID-19. And they're mostly located in Greater China. So comparative to the second point is that their Malaysia and Indonesia NPLs were up quarter on quarter. And it was also mentioned that this was mostly due to loan moratorium extensions, as well as the Pemule relief package in Malaysia. So I think in comparison to the other two banks, especially UOB, because DBS doesn't have much presence in Malaysia and Indonesia, was that it increased more than the UOB. So I would say that they are being more conservative by classifying some of these loans under support as NPLs. And I think that would probably be the reason why they are, like, in your words, taking such a beating.
SC Engineering, Terence, can you? Yeah. And also NanoFilm, if. Yeah.
Oh yeah, sure, Paul. I'll take the question on ST Engineering. We don't have any coverage of ST Engineering, but we can comment on some of their latest financials. So for ST Engineering, most of all of their business segments, like their aerospace, their defense, their satellite businesses, all actually recorded stronger growth in the second half of financial year 21. For their aerospace segment, for example, they grew by about 21% in the second half, and the defense also grew by 15%, and the satellite business also grew at the same pace with them. So for ST Engineering, the outlook for them is good because their order book reached a record, I think it's about $19 billion compared to the historical average of their order book, which is about 14 to 15 billion. So they've raised it to $19 billion. So for us, the way we will analyze ST Engineering is because they've set 5-year targets that they expect to hit by 2026. The targets were set in 2021, so 5 years. So they expect to hit these targets in 2026. So what we'll do is to benchmark their results with the 2026 targets that they set and see how they go to them. Obviously, the aerospace business now is the one that is holding them back because of the slowdown in traveling and everything. But what they're trying to do is to convert some of these planes from passenger planes to freighter planes. So that's supporting revenue now. But we do expect a recovery in the aerospace segment going forward. So that is good for ST Engineering. To reflect their confidence in the future, what ST Engineering is doing is that because traditionally they pay 15 cents of fixed dividend every year. So what they've done is to increase that 15 cents dividend to 16 cents now. And instead of paying on a half-yearly basis, they are paying on a quarterly basis now. So it's 4 cents every quarter. So that reflects their confidence in the outlook, even though the aerospace business is not yet fully recovered. But the commentary from them is most of their business, most of their customers rather, have seen a pickup in flow of passengers. So that's been good for the company. I'll go to the next question. Your outlook for Sembcorp. Our outlook for Sembcorp will continue to be positive. For FY22, we actually upgraded our earnings by 6.8%. For full year 22, it is expected to increase about 60% from because the recent spike in the commodity prices, I think like what Paul mentioned in his slides earlier, has actually resulted in better spreads for Sembcorp's business in some of their key markets like Singapore, in China, and in India as well. So for example, in Singapore, the USEP USEP price was trading about $140 and $150 in 2021. But because of this spike in commodity prices, today it's trading about $450 and it's still trending up. It's approaching about $500. So you can see that kind of spike being very positive for their business, especially the conventional energy business. So our outlook for Sembcorp continues to be positive in that regard. Nano film, I don't follow, so I'm not sure if any of my other colleagues can help with that. I'll take the next question on sets. Do you have any view on sets at current price? Sets is for us. Sets is a monopoly in the gateway business and the food and services business. So for sets, they also set a 5-year target that they're trying to achieve. For sets, we think at this level, it's probably priced in some of the recovery. So we don't cover sets, but our view is that at this level, it's probably priced in some of the recovery that is taking place post-COVID, the travel recovery. So we will probably be a little bit more cautious if we want to enter at this price until there's more certainty of the travel recovery, because their business is based on throughput, the number of passengers traveling through the Changi airport. So if the throughput increases, then that will be positive for sets. So at this level, we think that most of that recovery has already been priced in. So we'll be a bit more cautious. But if we see a more consistent recovery pattern, then it is probably worth it. Yeah, I think that's all from me. I'll hand back the time to the rest of my colleagues.
Hello, I will take the question on nanofilm. So for nanofilm, firstly, in general, the management did mention that due to the expansion of their Shanghai plant, so they just had a Shanghai plant 2, which just got operational. This resulted in the margins being impacted. So similar to what you would see, or what you would have seen for the Shanghai Plant 1 back in 2016, the net margins were actually down from 36% to 22%. And this time it was just down from 26.6% to 25.3%. This is on the net margin line. So considering that Shanghai Plant 2 is actually almost twice that of Shanghai Plant 1, and then this would be actually quite reasonable. And they also mentioned that the margins actually recovered already since the 4th quarter of 2021 as the sales came in from the Shanghai Plant 2. Yeah, so moving forward, we definitely will be expecting recovering margins. Then zooming into their individual segments, so the bulk of their revenue is made up of this advanced materials business unit, AMBU, about 80%. So they do this physical and chemical vapor deposition of advanced materials onto your phones, your tablets, your laptops. And this segment was impacted by supply chain disruptions. So with the supply chain expected to ease in FY22, they are expecting stronger growth, also maybe increasing demand from their main customers. Yeah, the IEBU was the main contributor to the growth in revenue, especially in the second half. So this is under this segment, they produce the industrial equipment, IEBU. And moving forward, I guess it's a bit more, the growth wouldn't be that much. In second half, it was 80% year-on-year revenue growth. So moving forward, it would just be introducing new equipment designs and also penetrating into the renewable energy industry. For the last segment, which is nano fabrication, actually this is quite it doesn't contribute much, around 3% of FY21 revenue, but they have this new project, micro lens array. So under this segment, they produce this optical lens. So under this MLA project for new generation wearables, it entered mass production in fourth quarter. So this would be another revenue driver going forward. Yeah, so that's all I have for nanofilm.
Okay, thanks. Let me just try to clear up the rest. Then I think we should. Could you rank some fertilizer and agri stocks on SGX to buy in view of the higher food and fertilizer costs? There are no fertilizer companies listed on the SGX. Of course, the agri ones that we mentioned are all the plantation companies. So unless you have some view on rubber, which hasn't moved at all, I'm not sure when it's going to move. Then maybe it's Halcyon. If rubber prices move. Apart from that, it will be just the palm oil prices, which are the most well represented on the SGX. Like we showed the list of Bumi Tama, Golden Agri. Yeah. So I mean, if you're playing this, then just buy whichever is the most liquid. Yeah. Sorry, I'm not sure how helpful was that, but any ETF at PhillipCapital focusing on commodities. We don't have a Phillip commodities itself, but I think there are of course lots of ETFs. I think. DBC, PDBC. So there's a lot of ETFs traded on the US, but in terms of, if you're asking if PhillipCapital issue, no, we don't issue any capital. We have inverse ETFs. That means if you are bearish on the market, you can buy those. Yeah, those are like that means if the market goes down, then the ETF is like shorting the Singapore market. I think we have that, but in terms of commodities, I think we have that PhillipCapital ETF. What's your view on dairy farm? What caused the share price to keep going down? A dairy farm has been hit firstly by the pandemic. So a lot of closures in their Malaysian, Hong Kong restaurants, their convenience stores in Indonesia and so forth, or retail stores. But the one that has been plaguing them the most has been Yong Hui, which is their associate. So I think their earnings was down probably at almost 200 million or 100 plus million. And 100 million of it came from Yong Hui. So Yong Hui is a supermarket chain in China. So that's the one that's really hurting their earnings the most. Again, I'm not an expert in China, so I'm not particularly sure whether it's e-commerce and they had some food quality headlines. But that is the Yong Hui is the one that's causing the impact. If there's a turnaround, I'm really not sure. I mean, but I can just. But the COVID-related business like their 7-Eleven, IKEA, that should recover. Because there's less lockdowns and normalization of activities. But near term should still be weak, I guess, because of what's happening in Hong Kong. Because they have Maxims there too. They have the Maxim restaurants there too. So these are all the headwinds. Yeah. Sorry, I don't really follow them that closely, but the big problem for them is Yong Hui, their supermarkets chain in China, which is one of the largest, if not the largest there, I think. What's the big reason why there's a big jump of Yang Chichang share price? Is the shipbuilding margins impacted? Yes, the older contracts are impacted, but like we mentioned, this kind of stocks, they don't move on margins or results. They move on order book. So I think the company is kind of guiding, I didn't stay for the whole presentation, but they're kind of guiding that maybe dry bulk will be the next round of where they'll get orders. So they have container ships, those who carry all those containers, and they have dry bulks because of the high commodity prices in ship, iron ore, grains, and all that. So that is the other thing that could be helping the orders in terms of dry bulkers. But I mean, this is as much as I can help you. Sorry. What's your? Do you expect UMS to cut dividends? No, I seriously doubt they'll cut dividends. I think the earnings will be another year of growth for them. So I doubt that they will cut any dividends. What's your view, Yang Chichang spin-off and issuance of? I think it would be a positive because I think Yang Chichang is trading below book, if I'm not mistaken. If I'm not mistaken, I'm sorry, but I think the spin-off would be positive. Then I think there's more value for investors, but it won't happen so soon. I think it'll probably take a couple more months, maybe middle of the year. Yeah, but I think it should be a positive because they can get better value for their financing or so-called HRm business. Yeah. What do you think of Olam as a stock? I'm not too particularly clear because they had a briefing, but they had a physical one, and nobody goes for physical briefing. But for Olam, yeah, I think the spin-off should actually capitalize the value. The last time we did some sums, it should be higher than their current market cap. So and with the commodities now, I'm not sure if they're a beneficiary. Actually, that's a good question, but I'm not very sure if they are benefiting from this. Yeah. Let us try to, I'll try and get in touch with them. Hopefully can get some insights. Yeah. Tech is hit by rising interest rates, while value is hit by rising costs and supply. Yeah, that's true. What else can we buy now? Banks. I think banks would be one. Regardless, even if the situation improves, the interest rate cycle is still intact. Maybe not as sharp as in the past, but it will still be intact. And if you look at how whether Ukraine war can affect the bad debts in Singapore, that's kind of a bit of a stretch if it's going to impact the asset quality in Singapore. So we think banks are still the healthy one, and any pure domestic names. Yeah, it's hard for us to kind of downgrade any particular stock because of Ukraine, apart from energy price, that Ukraine is going to hurt demand in Singapore. And we know that Singapore is going to reopen more. So the possibility middle of March, they could actually announce even more reopening. So we think the reopening play is still intact. But I'm not sure whether airlines will still be the ones, but because of high fuel costs. Yeah, but we still think the reopening recovery domestic Singapore is still intact. So for us, we no real change to our views, apart from oil price and so forth. Yeah. So it's hard for us to, not changing any of our recommendations because of the conflict in Ukraine. Is there a Singapore bank focused ETF and Phillips you recommend? Is there any ETF, Glenn? I guess the STI is already STI 40% is from banks. So I'm not sure if there's a pure focus. But I think sometimes you don't have to actually buy an ETF. I think you can just buy in equal proportions the three banks, and you're more or less build an ETF on your own. Yeah, I'm not sure how much an ETF can value add if you're just buying across the three banks. Yeah, because you can actually do it virtually yourself. Okay, sorry, I'm not sure if that was helpful, but I mean that's my own view. How do you see Genting as a recovery play? Yes, I think we definitely think Genting, because we think the government just going to keep on reopening. So Genting will recover, but just do note that Genting, this is a matured industry. So casino gambling, it is not, the young people do not go casino gambling. And the difference now is that the mainland Chinese can't come in yet. So you can play up to the pre-pandemic levels, but just do note that the earnings may not recover to those levels. Yeah, so Genting is also another, we think definitely a reopening recovery play too. Okay, we hope, okay, so those are all the questions. So thanks everyone for your questions. Yeah, some of it we really can't answer that well because it's a very fluid situation. But again, thank you everyone for your time and for your questions. And we hope to see you again next week. And thanks everyone. Take care and have a good week ahead. Bye-bye.